asset allocation, all of us understand, plays a very important role in determining the experience of an investor, whether it be returns or it be risk. Currently, we are seeing times where equity markets are struggling, and equity markets are trying to find out the bottom. Many equity investors who have actually seen cheerful times over the last 2 years are trying to kind of pray that bottom comes as soon as possible. But obviously, we cannot control equity markets beyond a point. What does bring up control in one's portfolio is the asset allocation, and I'm talking about the strategic asset allocation, which is one of the very important aspects. And in that regards, with equity, debt also plays a very, very important role. And today we know there are many products available for one to create a portfolio around various styles of investing into equities. But when it comes to debt, there is actually I would say, scarcity of products. Many investors, we keep meeting every day, always tell us that bring us anything which is interesting on the debt side. There used to be good debt mutual funds till 2 years ago, but because SEBI has actually brought certain norms, mutual funds on the debt side have actually become less attractive, because obviously mutual funds cater to the masses. But for the accredited class of HNIs and ultra HNIs, alternative investment funds offer something which is fine, and which kind of requires investors to understand before getting into that. And that is where we thought of doing this webinar, to understand corporate credit fund launched by Sundaram Alternates. So before we start the presentation and try to understand and deep dive the returns and the risk aspects of this fund, I would give you a background. Sundaram Alternates is wholly owned subsidiary of Sundaram Asset Management, which is a very well-known brand. And Sundaram Alternates, because we represent alternate side of business, PMS AIF World platform is a well-known platform, well-regarded and trusted platform all over India. And I can tell you, Sundaram Alternates have had many good products on the PMS side as well as on the AIF side, be it equity and debt, over the last more than a decade. And they have a very, very decent track record. Keeping that in mind, we are equally thrilled to understand from the fund management team, we have Mr. Chandan Kumar, who is an engineer, with a background, and brings with him 12 years of experience. And his forte is structured finance. And he's also MBA from XLRI Jamshedpur. And along with him, we have director from Sundaram Alternates, Mr. Karthik, who brings with him 22 years of experience and is a chartered accountant. So, from both these speakers, today we would try to understand the context, the concept, and the process of doing structured finance in this corporate credit AIF in terms of risks as well as return expectations. So over to you guys. A warm welcome to both of you. Karthik, you can maybe switch on your camera and start with first giving the context.
Sure. Thank you so much, Kamal and PMS AIF World. Thank you. Really appreciate the opportunity. Good afternoon, everyone. I hope I'm audible. Kamal, am I audible? Okay. So basically, just to add on to what Kamal mentioned, Sundaram Alternates, is a relatively new setup. I was on the same forum a couple of months earlier, and I had presented, what we're doing on the private credit side as far as the real estate credit is concerned. Where we are now on our third fund running. We have over 1,200 crores of transactions. Fairly good track record of generating 15% plus returns in the hands of investors through COVID, through GST, RERA, NBFC crisis, and all the material credit dislocations that have happened in the market over the last 4 years. So there's a fairly strong, understanding of how alternative credit works. We've designed our credit policies in such a way that, they have successfully withstood, all of these adverse events, and they've continued to generate quarterly cash distributions to our investors. Fund one of our real estate credit, where we raised a little over 400 crores is now 15.25% in the hands of investors. The fund has come to a close. It's a 4-year fund. Fund two, we launched in 2019, raised about 435 crores. Again, close to 15% return that will beat fund one. Probably will end up between 16 and 17% sort of return in the hands of investors, all senior secured product. And, that fund matures in 2026, but we've already returned 18% of that fund. Fund three, which is now open for investment as far as real estate credit is concerned, is a 750 crore fund, of which we are already close to about 400 crores. similar strategy, senior secured lending, and continue to make quarterly distributions and hitting those sort of return thresholds. So since we stabilized on the private credit side, the real estate credit platform over the last 4.5 years, the goal was to diversify into non-real estate credit, which is the topic for today. Structured finance is a very loose and large word, that is commonly used in the industry to denote everything, from senior secured debt to complete equity type risk exposures. So we in Sundaram are very, very focused. When we say private credit, we truly mean credit, because that is really the culture of the organization. Our ultimate holding company is Sundaram Finance, and while we have certain unique advantages within the Sundaram ecosystem, as far as the real estate credit side was concerned, we are seeking to similarly use the strengths of the group, and I will go through that in the following 30 odd minutes, and then open up for questions. Where we sought to design a product that can mimic in many ways what the real estate lending did for us, but on the commercial credit side, where we are targeting a combination of manufacturing and services business, largely in the small and mid-cap space, which are starved for bank lending and low-cost credit options. We're also looking at short-term, interim, bridge sort of financing deals, where there is bridges to liquidity, there are bridges to capital events, there are bridges to a material corporate reorganization, and then we're also looking at opportunities to do with financing, growing enterprises, through correcting their balance sheets, where the business is sound, cash flow generating, but essentially, they are looking at some sort of an ALM issue on their balance sheet, between short-term, long-term, needing capital for last mile capex, receivable securitization type structures. So I think while the opportunity is very, very wide, roughly in our estimate, between $7 to $10 billion in terms of demand for capital on an annual basis. The goal from a corporate credit side is to design a product that can be secured, provide a very strong capital protection in terms of hard assets and cash flow access, counterparty, where these are growing businesses, these are performing credits, there is no history of stress and delays and defaults and sort of taint, if you will. We have consistent coupons or cash generative instruments, which are able to pay income distributions to investors every quarter, like the real estate funds are doing. So there is an active current yield component that the investor would look at anywhere between 10 and 12% every quarter. So he really doesn't have to wait, even if he commits to a 5-6 year fund. He's not going to wait to realize that money towards the end of the fund. So effectively, starting the first quarter onwards, the investors will start seeing cash flow back, and so there is a gradual de-risking as well on the asset side by doing so. And we were also looking to target, like in the real estate side, anywhere between 16 to 18% sort of gross returns, where if you sort of drill down the waterfall, post fees and carried interest and all of that, the goal is to try and generate a 13-14% return from a post fee perspective and pre-tax perspective in the hands of investors. So this is the first fund that we are looking to launch, but we come with a sort of a rich sort of background in terms of what the group has to offer, which I'll go through. So Kamal, should I start the presentation? And then, so quickly introducing also Chandan. Chandan joins us from InCred, and essentially, has a fairly long history in terms of advising on structured credit transactions in the market. He's worked for a variety of organizations before InCred, very strong sourcing, background. And we're already, and we'll go through that in the presentation, already starting to look at a very aggressive portfolio build, and I'll explain how we're able to do that, even though you guys are very early listeners into our strategy, because we literally just launched the fund less than a fortnight ago. So you're very early in the game in terms of looking at this opportunity with us. Are you able to view the presentation?
Yes, Karthik, absolutely fine.
Okay. So, as I said, there are a couple of, I think most of you guys would be aware of the macro pointers, that are pointing to the fact that, obviously, macroeconomic pointers like GDP, demand for credit, growth-oriented investments, general sentiments in terms of future outlook, and so on. And it's fairly strong as far as corporate credit in the country is concerned. And so, roughly around $2.5 trillion of credit, of which largely I would say 70% to 75% supported by bank credit. So historically, banks have been financing at a very low cost everything from growth, capex, risks, including promoter equity, as far as the market is concerned, historically over the last several decades. But distinctly, we find that over the last 10 years or so, there has been a lull in terms of investment and credit offtake appetite. Banks have had their own fair share of issues. There have been tremendous sort of series of events, which have sort of pushed the general corporate performance up and down. We've had a series of regulatory measures since 2014-15, which over the long term have been very strong positives as far as equity markets and valuations are concerned. But it has actually left a gap as far as credit offtake is concerned. Banks were reorganizing between 2013 and probably 2019. So now they're reasonably flushed with funds, but essentially the focus over the last decade and a half has largely been on large credit, very chunky exposures and so on. So there is a distinct sort of gap in terms of MSME and SME credit offtake, not just because the banks don't have money, but I think the risk appetite vis-a-vis banks to look at businesses and evaluate them in the way they ought to be evaluated, leaves a very, very strong sort of gap today, which has emerged as a great opportunity for not just NBFCs, which are increasingly under the radar of RBI in terms of what they can and cannot do, but a lot of the alternative credit funds, private credit funds, whether they be bearings, and I'll come to that in a couple of slides down the line. There are probably about 8 or 10 new corporate credit funds that have emerged, over the last couple of years, that have sought to sort of take advantage of this space. And so we think this is a great time as an opportunity to enter the space where there is, on the one hand, a premium available for providing liquidity, and on the other hand, there is an opportunity to structure credit intelligently, where one can be structurally and asset-wise secured, and lend to situations that can extract pretty interesting risk-adjusted returns. So, as I said, all of this I just went through, but just to highlight the point, the opportunity is fairly broad-based, in terms of the size of annual demand for capital. We estimate, and I think many presentations that you guys may have seen, whether they are from UTI Ventures or any of these other corporate credit funds, and Kotak has recently been in the news to launch their own fund. But despite all the noise that are associated with new funds coming into the market, the demand for capital on the one hand is between 4 and 7 billion. I would think it's much higher than that. But on the other side, on the supply of capital, with all funds coming in, roughly, we are able to aggregate between $1 billion and $1.5 billion of new capital coming in to actually cater to this opportunity. So essentially, that leaves a huge sort of spread in terms of demand for capital of anywhere between $2.5 and $5 billion on an annual basis that is required for companies to grow, to access capital where they're not able to access equity markets, where they're not able to access private equity, where they're not able to access institutional bank money at low cost. And so as businesses build, generally between, let's say, revenues of 50 to 100 crores to, let's say, 1,500, 2,000 crores, there is a huge opportunity in terms of the number of companies seeking capital within this range across manufacturing, across services. And I'll come to in a couple of slides in terms of the unique value proposition that we are sort of looking at while designing this product. As I said, there are many funds who are looking at this opportunity. There's BPA, which is bearings, and Kotak has recently launched a fund. Centrum is looking at raising a fund. True North, which was largely a private equity fund in the past, mid-market buyout fund. They've launched a credit fund. Then on the left-hand side, you see large NBFCs like Aditya Birla, Tata Capital, focused on high-grade credit, which is sort of a AA, single A to a AA, and maybe in some cases AAA, where yields are anywhere between 5 and 7%. And on the right-hand side, extreme right-hand side, you see distressed and special sits, where there are very large pools of capital from overseas, whether they are Oaktree, Barde, SSG, which is now Eris, and so on and so forth, which are looking at very large chunky transactions, single tickets of between 100 and 250 million to sort of take over businesses, restructure balance sheets. And this would be examples of this would be, let's say, an India Bulls takeover to sort of restructure that entity and so on. And so there is a gap between the two in terms of performing credit, where we think that, there are transactions ranging between, let's say, 30 to 50 crores to, let's say, 150 to 200 crores, which are sweet spots for many of these mid-market credit funds, where, there are opportunities to provide capital on tenors of 3 to 4 years or 3 to 5 years, which can reasonably, sort of take businesses from, level A to level B to a next level point. Now, from a credit standpoint, these could be anywhere between a double B and a single A. It could be in some cases single B as well. But essentially the idea is that, the single B or the double B is not a reflection of sub-investment grade, but, these are companies that may just not be in the radar, of rating agencies, institutional lenders, and so on and so forth. So, there are healthy, growing, unlevered, businesses, and, perhaps some levered, difficult situations, which can be acquisition targets for companies like this. And Chandan will go through some of the sample transactions to give you a sense of what we're looking at, that are, very interesting opportunities, for us to be able to go in and, let's say, lend 50, 60 crores on, let's say, 4 to 5 years of tenor, be anywhere between 1.2 to 1.5 times secured, based on, business cash, assets of the business, promoter collateral, and so on, and be able to charge, coupons ranging between 13 to 15%, and be able to generate IRRs of 17, 18%. So, this is sort of, the broad universe of businesses and companies and situations that we're looking at. And so that's really the middle path, of the ECHO strategy. By the way, we're called Emerging Corporate Credit Opportunities Fund. So abridged an acronym as ECHO. So if you hear me say ECHO, it's actually referring to the name of the fund. So that's really where ECHO is positioned. Like I said, the different kinds of opportunities that go into a portfolio buildup or a portfolio construct, from where we are sitting, are ranging between operating company financing, which is really going into finance, growth by way of providing working capital, which are backed by, receivables. In the case of manufacturing, assets relating to plant and equipment and land and so on, to, equity type requirements, which, you're able to structure not as equity, but, as secured debt, but they're really equity bridges, where businesses are already supporting, that infusion with strong cash flows and ability to provide collaterals and so on. Then, as I mentioned 10 minutes ago, interim or bridge financing, event financing transactions, whether it is to an IPO, or whether it is towards hiving off a particular asset, which is, getting in private equity, or a last mile financing, which can actually be refinanced, maybe 2 years down the line or a year down the line through low cost bank credit, stuff like that, which are a plethora of needs, that mid corporates go through. And then there are hard asset backed deals, typically in asset heavy industries, like hotels, hospitals, schools and colleges, and, parts of infrastructure. We don't really focus on core infrastructure, because core infrastructure is a very long gestation game and has access to low cost project financing capital. So our goal is to look at, while it's on the asset heavy business on hard asset backed deals, we're able to get strong collateral, but we're also looking at cash flow generation to be able to get an average duration on a 4 to 5 year tenor of anywhere between 2.5 to 3.5 years. So essentially, a combination of, and of course, financial inclusion is an important aspect for us, and it's not just a buzzword from a social impact perspective. We are actively looking at transactions, where we are able to do things like tier 2 sub debt on high performing NBFCs, microfinance institutions, and so on and so forth. But these are secured either on balance sheet or off balance sheet through corporate guarantees holdco guarantees, very strong promoter collateral, so on and so forth. So in all cases, the common thread that runs through a couple of common threads that run through our portfolio construction are secured transactions, consistent interest generation, coupon generation, which in turn we can distribute as income every quarter to our investors, and also helps keep risk off all the time. We're not doing back-ended transactions. Performing credit, which are cash flow generating businesses, where we can reasonably do diligence and be in a position to understand that these are sustainable over the course of the lending that we're doing. Reasonably strong counterparties, who are engaged with growing businesses, performing credit. They're not really, businesses or promoters who are tainted or who are in stress, deep distress, and so on and so forth. And at the end of the day, the idea is, within a 6-year duration in terms of the fund, our goal is to do 4 to 5 year transactions that consistently churn capital and not just give a current yield to the investor, but also from an absolute return perspective, they're able to generate anywhere between, 1.3 to 1.5x, over the course of, the fund, which are pretty strong equity type sort of multiples, built on the back of a senior secured fund and a consistent recycling of the principal portion of the capital. So I think the goal is to generate in all cases, around 16 to 17%, pushing that 18% handle all the time from a gross return perspective, so that the net returns to investors, can be in that 13% to 14% range, that we're sort of doing as far as the real estate credit side is concerned. So that's really the logic for the portfolio buildup. And so this is again, what I already said. I'm not going to repeat myself, but this is all the stuff that I went through in terms of how the waterfall in terms of returns flow back to our investors and how we expect the credit to perform. By the way, for any of y'all who are interested, I'm sure through post the call, we're happy to we have a ton of material in terms of investor pitch decks, collaterals, and so on and so forth that we can run through. And so if any of you is interested in making a commitment, please do reach out to us after the call, and we can help you go through the opportunity. So as I mentioned upfront, there are a couple of pretty interesting reasons why Sundaram is embarking into this whole alternate credit or private credit space. There are just by way of a macro background, Sundaram Finance, which many of you may be aware, is a AAA rated NBFC, roughly 30,000 crores of book, very strong promoter background, TVS family, well capitalized, extremely strong customer and brand recall. So it has 3 subsidiaries. The first subsidiary is an insurance business, which is a general insurance, Royal Sundaram. The second is a home finance, home loan mortgages business, Sundaram Housing Finance. And the third is Sundaram AMC, which you are aware, which run the debt and the equity mutual fund schemes. And below that is where Sundaram Alternates, is positioned. And so, if you look at the group, there are the logic for real estate, just to take a step back from the corporate credit fund was that as an opportunity, it is interesting. There is premium to provide liquidity. It's a sustainable opportunity that can be scaled over multiple funds. Our focus has been on the real estate side, purely on the south. And the goal is to try and use the Sundaram ecosystem in terms of Sundaram home finance offices to generate transactions, originate deals, get an access to a lot of pre-investment due diligence, be in a position, to be able to do post-investment monitoring, through the sort of reach that we have in the geographies that we are focused on. It was particularly useful during COVID lockdowns where, we were not able to travel. The Sundaram Home Finance offices in all of the locations in Bangalore, Hyderabad, Kochi, etc., we're able to go in and look at projects and so on and so forth. So, there was a strong orientation coming from home finance as a proxy to the real estate business. So in the case of the corporate credit or the Eco Fund, the logic is similar. So on the one hand, we have Sundaram Finance as a sponsor, which is making a very sizable commitment as far as this fund is concerned. We're looking to raise about 750 crores. We have 500 crores on the label of the fund that we're looking to base, and there is a green shoe of 500 crores. But the goal is to try and raise 750 crores in the Eco Series 1. And within that, 150 crores is already committed as sponsor commitment from Sundaram Finance. So that's, probably in my understanding, and I've gone through 14 other funds which are similarly structured, one of the highest sponsor commitments, that you can find by way of comfort and skin in the game, that any sponsor is actually contributing towards a fund. So 150 crores of sponsor commitment. In addition, there is also a commitment for Sundaram Finance in its own balance sheet, because a bulk of its balance sheet is equipment finance and so on. But there are pockets within Sundaram's balance sheet, which are focused on things like financial inclusion or bank credit, NBFC credit. There is a pocket that looks at channel financing, wholesale credit. Two customers, who've been in the ecosystem for a very long time. There is Sundaram AMC, which from an equity standpoint is focused on mid-market credit, and our own AIF category 3 funds, which focused on nano cap, consumer, and so on and so forth, have a wide range of access to promoters, businesses, companies, which are positioned in, let's say, the 500 to 2,000 crore revenue range, which are all interesting targets for us to be able to offer credit solutions. So from a sponsor commitment, there's Sundaram Finance. From a co-lending strength to the fund and return juicing to the fund, there is a co-lending commitment of anywhere between 250 to 300 crores per annum coming from Sundaram Finance balance sheet that will co-lend with the fund. And Sundaram Finance actually lends at a significantly lower cost. So the entire benefit of the rate arbitrage will actually come to the funds. And be in a position to be able to achieve, that 17-18% return threshold that we are looking at, while retaining the enforcement advantages of Sundaram Finance as a balance sheet, access, to deals, pre-investment or due diligence, origination, and so on. But there is also, from a Sundaram AMC perspective, access to anywhere between 150 to 200 promoters, who are positioned, with 500 to 2,000 crore revenue businesses. Where we are already in discussions on offering credit solutions, because they may not want to access equity markets, because they may want valuations. They may actually want interim financing or bridge financing money, and may not be looking to dilute for the longer term. So there are a host of different origination possibilities that come from Sundaram AMC's business, for a strategy like this. So when you actually look at it as an umbrella, there's a pretty interesting mix of access to finance and promoter contributions, deal origination and pre-investment due diligence, positioning vis-a-vis South markets, and the Eco Fund, unlike real estate, will also look at opportunities in the engineering belts of, let's say Maharashtra, Gujarat, and so on, where TVS as a group, the sister concern or the same family of Sundaram Finance also has significant expertise in automotive engineering, components business, whether it's Brakes India and Turbo and many other companies in the business, where there's a lot of domain knowledge, that, we can use in terms of credit research, ability to understand business, industry trends, and so on and so forth, which give us a significant advantage in terms of hitting the ground running, to look at opportunities that, we can actually improve our turnaround time, understand the business fairly quickly. So, from an assets perspective or a target sectors perspective, while we will continue to look at things, which are opportunistic, whether they are services and many of the sectors that I mentioned in a couple of the earlier slides, the core sectors for us, would be across manufacturing, would be businesses located in the South and so on, where we are already having access to, significant amount of touch points vis-a-vis promoters and consequently deals. So, as an umbrella, there's a significant amount of, leveraging, as the slide says, of the Sundaram ecosystem that will help us hit the ground running. So aside of all of this, the very interesting piece for the Echo Series 1, which we are also using as a pretty interesting way to build the portfolio, is that Sundaram Finance will also warehouse transactions for the fund, till the fund is raised. So, for example, we're already, 3 term sheets out into the market, where we have already given a term sheet to a textiles business in the Tirupur area in the south, near Coimbatore. We've given a term sheet out to a pharmaceutical company that is looking to do a corporate restructuring. It's a private equity backed business, that's based out of Mumbai. We're also looking at another transaction in insurance and healthcare in Bangalore, which is looking at a consolidation play in terms of acquisition financing. So all of these transactions range between, let's say, 30 and 60 crores, where Sundaram Finance is willing to warehouse at a very low cost transactions, which the fund can buy into as and when it achieves its first, second, and third closures. So the ability of the fund to sort of collect capital, look at a blind pool type concept, then go out and look at transactions, etc., is sort of circumvented with the fact that over the last 3-4 months, as we sort of geared up to launch this fund, we've already started aggressively looking in the market at opportunities to build a pipeline. And I think later in this presentation, I'm going to let Chandan go through very quickly, a bunch of transactions that we're looking at as far as this fund is concerned. And we're in a position to consummate all of those deals and buy that into the fund as soon as we achieve the first close, which we're targeting sometime, in July, August. So, with this, I'll probably, Chandan, maybe you can quickly go through, the unique value proposition in each of these businesses, touching upon the security, the yield, and, essentially, what is the key sort of reason why we're looking at each of these transactions very quickly, for our audience. And then I'll sort of circle up on the next steps.
Sure. Thanks, Karthik. Hello, everyone. Thanks for this opportunity. As Karthik explained, we are already actively scouting for opportunities across diverse sectors, focused on mid-market structured credit needs. And we have seen good traction in terms of transaction availability, reception from borrowers to avail a structured credit requirement because they find alternate sources a bit difficult to assess or much more time consuming. So as you can see, we already have a roughly 425 crore pipeline that's presented on a screen. And it's across diversified sectors, diversified from textiles to pharma, healthcare, hospitality, and insurance services. So on a sample basis, I'll touch upon a couple of deals to walk you through the flavor of the transactions that we evaluate. So as you can see, one deal that we are evaluating actively, and we have signed the term sheet and diligence stages in pharmaceuticals space, wherein two seasoned executives who have handled billion-dollar businesses in their professional capacity, and they founded a domestic formulations company, and the formulations company is profitable, valued at 1,000 crore, significant PE investment there in the company. So it ticks all the boxes. And these promoters want to acquire API asset and backward integrate to manufacturing pharmaceutical products. And for that, we are evaluating a 45 crore proposal. And this asset itself will be a business that they are acquiring, will give almost 1.25x cover. And additionally, this facility will be secured by a corporate guarantee of a formulations business, which is valued 1,000 crore. PE investors have an interest in this overall transaction because promoter is giving them a post-sliver of equity as a reward for supporting the acquisition by way of extension of guarantee. And potentially this pharma plant can act as a feeder and supply to the formulation company, and it can cater to other players as well. So this transaction ticks all the boxes of like established promoter with proven credentials to have run the business. It has a good security cover, good operating cash flows from day zero will be in the operating company. And above all, it has been backed by a guarantee from a business which is profitable, equity valued at 1,000 crore, and negligible net debt. So that's a overall construct of the transaction. Why we are able to do this transaction is because since this is a start of a new business by experienced promoter, it doesn't fit into traditional requirement of PSU banking setup, and its transaction size as it's a 45 crore. So it's not large enough to excite large global funds or funds like Edelweiss who are in looking for deals upward of 150 to 200 crore. So this is the one opportunity. Similarly, we are evaluating another exciting opportunity in a company which provides services to insurance sector. Uh, a well-known, well-established promoter is trying to acquire a business, and we are trying to fund acquisition with 50-50 mix, wherein 50% of the credit will be predicated on targets, targets cash flows and targets assets, and balance 50% will either come from promoters or will be backed by uh, sources outside the business. And overall, business will have a consolidated debt EBITDA of less than 4x, as and when transaction gets consummated. Transaction is interesting because underlying business is capital light. It has a negative working capital cycle to say rather than large funds tied up in inventory or receivables. Here, the company receives billing in advance and provides services over a period. So overall, it's a free cash flow generating business, less than 4x EBITDA leverage, and good asset cover, all combined, provides attractive value proposition. This proposition would be difficult to pass through any banking setup because banks are not permitted to do such acquisition financing. Traditional NBFCs may compete with us, but there would be slight difficulty in terms of their ability to understand and do diligence in a services sector, wherein we have an added advantage of getting quick feedback, understand business better by virtue of being part of Sundaram ecosystem, wherein domain knowledge for insurance is there. So we have captured pharma, insurance. We are doing another deal wherein we are signed a term sheet. Is in textile sector in Tirupur, as Karthik mentioned. In this deal, textile it's a revival play wherein business is already generating significant EBITDA, and our leverage would be closer to 3.5 to 3.75x post transaction. And there is a situation because in industry downturn for textile, this company has faced certain difficulties and irregularity in debt payment. And we will be refinancing existing lenders. And promoter is bringing in his personal assets into the play, and a committed monetization plan of non-core assets to reduce the exposure by half in agreed time period. And promoter's second generation is getting involved into the business. So, and second generation is committed to the revival of business, and its commitment is shown by extension of guarantee by second generation as well. So overall, it's relatively a smaller deal of 22 crores, but we wanted to we want to proceed this transaction because it's in one of our areas where we can diligence it with wide stakeholders, including suppliers of the business, customers of the business, as well as we have local market intelligence on the promoter and the business in this segment. It's backed by almost 2x hard collateral, and then collateral of plant and machinery, working capital set aside,
Okay.
and significant significant operating cash flows in the business. So that's the flavor. This is the kind of deals that we are seeing in the market, wherein for various reasons, access to traditional mainstream channels of finance is restricted, and there is opportunity for a fund like us to to participate it and generate a superior risk reward for investors. We have
that's, if I may add to what Chandan said, I think that's a great if you don't mind me interrupting, Chandan.
Yeah,
So I think
sure.
I wanted to make some important points for the benefit of our audience. While we have presented in this presentation 440 crores of transactions, we have actually seen close to 2,500 crores of deals. All right, and so these are discussions on deals which have passed our credit filters. And I neglected to mention that we, like in the case of our earlier funds and typical to how Sundaram operates, we have a set of credit rules. Not just about security and returns and so on and so forth, but also about underlying businesses in terms of what kind of debt EBITDAs they ought to have had. What kind of velocity in terms of cash flow are we seeing that is likely to pass through our escrow? What is the sort of sustainability of the revenues and the margins of the business that we have been able to diligence, or we will be able to diligence, and consequently how can we structure the transactions, even if it is a 4-year or a 5-year tenor, like many of these deals are. How do we sort of ensure that we're going to get money back in 2.5 to 3 years? So for example, the textile deal that Chandan mentioned to you, the whole deal is predicated on the fact that the promoter has so much of assets which is already under discussion to monetize or sell, which within the first 1 year is likely to repay 50% of the capital. So this is an interesting transaction where, as we look to build the portfolio of the fund, we're generating 20-21% return, which is a very nice kicker to the initial portfolio build, that will hold the portfolio at a certain sort of value, and then we are able to recycle that capital fairly fast. So it's a shorter tenor sort of transaction, even though the underlying underwriting on a hold to maturity basis is based on a 5-year sort of tenor. So similarly, every deal we look to see that, okay, how can we sort of structure the deal to, first of all, even if it is anywhere a sub investment grade risk, how can it become investment grade in terms of security structure, quality of the collateral, cash flow, visibility of the business, ability of the debt to be senior and sold secured vis-a-vis other lenders to the enterprise. How do we get priority in terms of cash flow, enforceability of our collateral in various judicial forums, and so on and so forth, is a series of credit rules that we have written for ourselves, which go into this sort of portfolio build-up. So this 440 crores is actually active discussions on transactions out of a 2,500 crore sort of pipeline that we've seen in the last 4 to 5 months. So, as I mentioned right up front, the opportunity is very large, and the ability for us to create a portfolio exists in terms of yield kickers, consistent cash flow generation, repayments which can be recycled from a principal perspective to generate absolute returns for our investors, and capital protect the portfolio from an underlying sort of security and seniority and structurally senior cash flow risk as far as the underlying is concerned. And as you can see, the blended portfolio return on a weighted basis is close to 18%, and so that is really what we are shooting for in terms of back calculating what the investor will get in his or her hands. So I think that is sort of broadly the portfolio construct, and we can get into all sorts of details, but I'm a little conscious of time that we have here. But this is just to give you an idea of the kind of deals and the kind of structuring and how we look at credit in general. So the fund itself is an AIF category 2. We are looking at 6 years as far as the fund life is concerned. The idea, although we have 500 crores base and 500 crores green shoe, the idea is to raise close to 750 crores with such a strong sponsor commitment, co-investment from Sundaram Finance, etc., and the ability to start investing very, very quickly in the market. We have various classes of unit holders or shareholders, share classes, as is typical to AIF category 2 funds. And so typically minimum investment as regulated by SEBI is 1 crore. So between 1 and 5 crores is 2% management fee, and we have a hurdle rate of 12. We've set a pretty high bar, and many of the other funds have hurdle rates of 11%, 10% from what we've seen. But we've said that let's be investor friendly and stick to the 12% hurdle. And if we make a return net of fees to the investor beyond 12, then there is a 20% profit sharing to us, and 80% goes to the investor. So the idea is really, and this is all without catch up, so it's all back ended. And so if the fund makes money and the investor makes money, then we make money as a manager. Class B is between 5 and 10 crores, 1.75%. Class C is between 10 and 25 crores, that is 1.5%. And then we have a bunch of investors who are looking to anchor the fund, whom we are in discussions with, who will make individual commitments beyond 25 crores. Typically, the conversations that we are having are ranging between 25 to 50 crores, and so for them, the annual management fee is 1%. So that's roughly where it is. We will, like all the other funds, be declaring a quarterly NAV. We'll be circulating quarterly newsletters as we are doing in our real estate credit funds. And so there is a full look through transparency in terms of reporting, and everything that you would expect out of Sundaram as an asset manager is something that we are committed to do. And from a timeline perspective, as I mentioned right up front, this is very early in the fund launch stage, where we've literally launched the fund less than a fortnight ago. The goal is to try and do a first close by around August. We are shooting for anywhere between 200 250 crores as a first close. And so we are aggressively in conversations with investors, and along with the sponsor commitment, we intend to start investing in the market. We'll be looking at a second close in the early part of next year, and the idea is not to keep the fund open for very long. So if we're sitting in May, the goal is to try and close by March of 2023 as an end date. But having said that, the investors, as and when they come into closes, will start generating return for their investment in the quarter that follows their investment, because we're already looking at deals, and there is, as I mentioned, a warehousing component of the investment. So as and when the fund achieves a closure, it would buy deals that are already closed from a warehousing perspective, which are already yield generating. So in the quarter following the investment, the investor should look to start receiving yields. Obviously, it takes time for the portfolio to build to achieve the optimal full yield on the book, but the income would start flowing in the quarter that follows the investment. From a drawdown perspective, just proactively, we're looking at a 25% drawdown on the first close, and then the balance 75% is drawn over a span of a year, as and when we look at transactions, so that we don't have cash drag and impact and return impacting situations from a treasury standpoint to the investors. And then obviously we're looking at a final drawdown within a year. And as I said upfront, the goal is to be a current yielding fund, which is like an annuity fund. So effectively every quarter there is income distribution back to investors, so that they continue to enjoy some yield from the book. And typically, as you can expect, that chunky capital repayments will start happening at the time when we can no longer recycle the principal piece of the investment. So that will start happening towards the end of let's say year 3 or the beginning of year 4. So between year 4 and let's say year 6, which is the end maturity of the fund, you would look to get capital back. So essentially, from a cash in to cash out perspective, we're looking at roughly about 4 years of money. So because the drawdown is also staggered and the return of capital is also staggered, so an average duration for capital we expect to be roughly around 4 years as far as this fund. So in the case of our real estate funds, is actually closer to about 3.5 years from a cash in cash out perspective. But corporate credit is something that might take a little longer from a gestation standpoint, but the goal is to keep compensating the investor for liquidity tie-ups, because locking in the liquidity by periodic distributions of income and capital. So I think that's about all that we have as far as the product itself is concerned. Just to summarize, it is an interesting opportunity to beat typical corporate credit from a debt allocation, where typically you're looking at anywhere between 5 to 7% yields, but the goal is to try and achieve that is basically pre-tax in terms of typically returns that you can find from any of these investments that are available in the market. But we are looking to sort of beat that and try and get to around a 12-13%. And so you can do your own post-tax calculations. And obviously this is a category 2, so the maximum marginal rate of tax will apply, and we're not in control of that. But the idea is to have a diversification in the portfolio, so that there is a very strong capital protection perspective, significant skin in the game from sponsors in terms of supporting the fund and being pari passu on the cap structure. From a deal perspective, the idea is to do secured, sole creditor perspective on assets that are charged to us. We look at periodic income distribution so that you get a current yield, and basically the goal is that we will have a 200 to 300 basis point difference between typical corporate credit, if not more, as far as looking at a fund like this is concerned. So with that, I'm not going to repeat too many of what I said, and I will open it up to Q&A. Kamal, if that's okay with you.
Sure. Thanks, Karthik. I think we'll have to repeat some things. I may ask you repetitive questions because you have covered everything. However, from the point of view of investors who only want to analyze a product like this primarily from the perspective of risks.
Sure.
The foremost question I think that everybody's wanting to ask, over chat as well as the WhatsApp messages that I'm receiving while you were giving the presentation, is that how is this possible that you are able to identify, a clean lending opportunity at 16%? What is the type of company? Is it, you can say a startup level business or a listed company, who is ready to raise money at 16% when the market environment is kind of at very low interest rates? And why can't, if that company is good enough, why can't they raise money from a bank? And why is it that they need to approach an AIF? So obviously, there are definitely some risks which are involved, and you take care of those risks by following a process, by following a collaterals, right? So if you could cover that, by taking an example of a company, or maybe naming a company, that will be actually more, meaningful in terms of understanding the whole proposition.
Sure. I may not be able to name it, Kamal, because we're under confidentiality, but nevertheless, I understand the question. So what I can tell you is that these are not startup risks. Okay, as I mentioned a few times, during the course of the presentation, we are targeting companies with, let's say, turnovers ranging from 50, 100 crores to 800,000 crores. Okay. For example, the pharmaceutical company that Chandan mentioned has a turnover on the generic side of close to 400 crores. A healthy company, no leverage, private equity owned, very strong, cash flow generating, etc. So, but what happens, in terms of why we are able to charge 16, 17, is because of the particular situation that surrounds, that transaction. So, for example, in the pharmaceutical company, there is a regulatory arbitrage situation where the generics company, the promoters of the generics company, have actually gone ahead and acquired 2 API units, and there is a debate that has happened between the promoters and the private equity guys, who are owning majority in the company, where the private equity guys are saying, look, I've been on your balance sheet for 5-6 years. And the business is actually doing very well. We need to look at an IPO and things like that. And at this stage, if you go and acquire an API business, which is earnings dilutive, to the generics business that I have invested in, from an equity standpoint, how does that make sense to me? Especially when my fund is looking to exit right now. So as a consequence of that, the promoters have decided to hive off or demerge the API business from the generics holdco into a separate company, which we are funding. So basically, what we are funding is the promoters, and the promoters use our money to actually buy the API business from the generics company and house it in a separate company. And we have a sort of an undertaking and guarantees and assurances from the holdco, in terms of providing a backstop to our loan, aside of cash flows that are getting generated from the API business itself, which on a hold to maturity basis will pay us down. So now this is typically a transaction that a bank cannot do. So the bank cannot do promoter financing against a future corporate finance event, for example. So there is a regulatory arbitrage or a commercial arbitrage here. The other situation on the textile company is quite similar, where the idea is to fund an acquisition of a unit which is generating cash but is an NCLT, right? So we can see cash flows. We've diligenced the cash flows over the last 3 months. We've seen day-on-day cash flows and so on and so forth. But for whatever reason, historically, the business has gone into NCLT. So the idea is that when you purchase that particular unit out of NCLT and settle the lenders, at a discount, it is already cash flow generating. But this transaction, a bank cannot do. again because of regulatory arbitrage, and in the third transaction where it is an aggregation of insurance TPA businesses, again it's a regulatory arbitrage where banks cannot finance acquisitions, so that's actually again one of the restrictions imposed by RBI. So there are a host of situations where either there's a regulatory restriction on banks to be able to finance, or there is a commercial arbitrage in terms of the deal has to happen very quickly and nobody can actually step in and do the diligence, and we know the asset intimately at that stage, or there is a situation where it is an industry precedent that banks and NBFCs are typically not able to fund this. Not to say that NBFCs and banks cannot do loan against shares, bear that in mind. So, there are many NBFCs like JM, etc., which are doing loan against shares. But, those are typically stock market transactions and, publicly listed transactions where, those are liquid shares and you do margin calls and things like that, which are typically part of the industry or trade. But in private transactions where, there is situations like this, NBFCs are typically not having the due diligence capability nor the sort of credit appetite to get into situations like this. So which is really opens up a whole bunch of opportunities for us to go into particular situations like this. And by the way, all companies, including 1,000 crore, 1,500 crore companies are doing acquisitions. They are doing corporate reorganizations. They are doing promoter takeouts. They are doing consolidation trades. We unfortunately, our fund we launched, it's in the public listed market. I mean, it's in public market, so I can talk about it. There is a Bangalore company called Happiest Minds, which IPO'd, several months ago, actually 8 months ago. And, we were one of the first to get a look at that transaction, to be able to fund them. And the promoter is extremely strong, Mr. Ashok Soota is, backing that transaction. And so we had an ability to fund that transaction at, 16, 17%. We couldn't, and we referred the transaction to a vendors to be able to do, so they actually made a killing on the trade. So, there are opportunities like this, whether they are in manufacturing, whether they are in healthcare, whether they are in IT services, where as a general process of corporate evolution, businesses go through many of these situations, which are available for financing to us. And that is why I mentioned half an hour ago that, in the Sundaram ecosystem, between Sundaram AMC, between Sundaram Finance's own balance sheet, and between what we are originating in the market, there is a whole bunch of companies, situations, promoters, and deals, which fit these criteria, which are not typically financeable, by banks. So as I speak, Kamal, I'm looking at many comments on the chat where people are saying it is audio and is not heard. So I hope much of what I said is what people were able to hear it. But essentially the answer to your question is this, that the reason why people are able to or willing to pay us 16, 17 is because it's a transaction which they can't go and dilute equity in the equity markets. It's not a typical private equity trade that they can raise 30, 40 crores when, let's say, 2 years down the line, they're looking to actually raise 200 crores. So it actually falls, in that sort of bridge between a company that is ripe for a listing or a follow-on offering or a private equity trade. And it's not typically financeable by project finance, working capital financing, overdraft, CC, etc. by banks. So it sort of falls in between. And increasingly, as corporates look to grow, organically and inorganically, there is a whole bunch of these end users, that are typically comprising, this alternative credit or private credit market, which is really why, you're seeing a proliferation of these funds that are coming. So the long answer to your question is that, there is situations that offer premium for providing that liquidity. And typically promoters also look at situations where they're saying, look, I'm going to hold on to the 16, 17% capital for, let's say, 2 years. I'm not going to look at a horizon beyond that because, the purpose for which I borrowed this capital is solved. I'm able to either raise cheaper forms of capital or the business is generating sufficient cash flow for me to pay this down and get this cost off my balance sheet. So that's typically the logic that, we are using as far as corporate credit is concerned, which is quite similar to the logic, by the way, that we used in the real estate side as well. We're saying, even though, it was a 4-year trade in real estate, the goal is that, we're lending there at, 18, 19%. And the idea is that, our financing on an average has not stayed on the balance sheet of a borrower on 25 transactions, beyond, let's say, 2.5 years. So within 2.5 years on a 4-5 year fund, we've recovered 100% of the capital with returns back. So the idea is to do similar stuff on the corporate credit side, provide that liquidity when the businesses and the promoters need it, so that they are able to actually continue to achieve that growth organically and inorganically. And either between the business cash flows and corporate credit events, we get paid back fairly quickly. So I think that is, as I see in the chat box, this is the answer to a whole range of the questions that have been asked. And so it does not entail necessarily high risk. Certainly there is a risk in everything that you invest. I'm not going to sit here and say that, it's 100% capital guaranteed and so on and so forth. So there is execution risks, there is underlying business risks, which is really why the diligence that we do is typically spread across 3 sort of angles. One is on the business itself in terms of sustainability of revenues, history and track record of how it has performed, current sort of trends in that particular subsector, whether it's textiles or pharma and so on, is that seeing an uptrend? Are we able to see that, that is likely to exist over the next 24 to 36 months, so that the cash flow visibility is strong to be able to, create this kind of liquidity that we're looking to get paid down. So the idea is that on a 5-year deal, we should get paid down anywhere between 60 to 70% of the deal at the end of year 3. So mathematically, that's the way in which you completely de-risk. And if you actually get 60 to 70% of the principal back, that means with returns, you've recovered anywhere between 90 to 100% of the capital back. So that's typically the way the compounding of these returns work. And so at the end of year 3, if you're sitting on 100% capital back from a capital at risk point of view, you're actually done a pretty good transaction, and you've created enough incentive for the promoter to be able to take you off the balance sheet, because he's now thinking that, look, this guy is sitting and sucking all my cash on the balance sheet, so let me just get him off the cap structure as quickly as I can. So that's typically how we look at it. I'm just going through some of the other questions. Taxation is the maximum marginal rate. It's a pass-through vehicle as a category 2. And so it is taxed in the hands of investors. What is the percentage and probability of some investments going dud? From Mr. MP Singh. So, sir, I think the honest answer to that is, I'm not going to sit here and say that it's a bulletproof business. There is always a possibility of the bet going sideways. But what we've done, within our credit rules to sort of mitigate the impact of that, is to be secured in 2 ways, not just from the business in terms of business cash flow escrows, lien on the primary business accounts, access to mortgage of business assets, whether it's plant and machinery in the case of a manufacturing business, or real estate owned by the business in the case of services and so on. But the second form of collateral that we are seeking to have is also from the promoters themselves, where we are asking the promoters to not just put skin in the game in terms of enough equity in the business, but also in terms of are they able to provide their personal assets, whether that is real estate that they own, lands that they have, other business interests where they are looking to pledge. They will be asked to pledge shares of that business to us, and these are material pledges upwards of 26% to controlling pledges. So the idea is that there is also a significant amount of things to lose in the hands of promoters, alongside being secured vis-a-vis the business on a hold to maturity model. So it's like a twin security structure that we are seeking to achieve on transactions. So from the way in which we've constructed our credit rules, I would say the probability of us losing capital on transactions should be fairly low, as in the case of real estate, where we've lost 0 capital. And real estate, one would argue, is way more risky, at least as I've been told, by investors, such as yourselves. We've lost on 25 transactions 0 capital, and we've recovered 100%, and we've managed to generate returns upwards of 15% in the hands of investors. So the goal is the credit rules are strong enough to be able to sort of withstand volatility as far as the business is concerned within bands. But of course, look, if the business goes completely kaput and the underlying bet is wrong, which we think is very remote, considering the fact that this is the approach that we're having, we can't do anything about it. But from a portfolio construct, the idea is there is enough diversification that we would do anywhere around 10% to 12% of the fund in every single transaction, probably lesser. And, if our average sweet spot is around 50 crores and, we're raising 750 crores, that's roughly less than 10% in every single transaction. So there is enough portfolio diversity as well. So even if, to your point, one deal goes dud, then the rest of the portfolio comes in with returns, and on a portfolio basis, all capital of the investor is protected. So I think that's the way we are looking to construct the portfolio, aside of very strong underwriting rules and capital protection on every single deal. So I think most of the other questions have been not able to hear audio.
Is the product available to NRI clients or only for domestic clients?
Product is available to NRI clients. They can invest either through their rupee accounts or through their NRE accounts. And this is available not just on this product, but on all category 2 funds. And so that is very much possible.
Any particular countries, which are prohibited to invest in this fund?
So I don't think we're allowed to market to North America, which is USA and Canada. And so largely, we've seen interest historically in our private credit funds from the Middle East, Southeast Asia, and so on. But I can come back to you on that. But I don't think, to my knowledge, there is restrictions. If an NRI is sitting in the US and he wants to put in money into our funds through his NRE or rupee accounts, I don't think there is anything stopping him or her.
Right. So to sum it up, everyone, first of all, thank you for joining us today. The fund, in my opinion, is a very good and rare and unique opportunity for investors looking to consider an investment option in the debt space, provided you have a horizon of 4 to 5 years to be able to commit to a space like private credit, which requires a deep understanding. It definitely has some element of risk, but because it comes from a fund house which has deep and decent track record in terms of managing this space, and it comes, with hands-on approach and risk mitigation mechanism, which is being executed very well in the past real estate and other private credit funds. It definitely requires, it definitely, has a merit in that regards, and that is kind of makes us confident to do webinar with this team. I think, all of our questions with regards to expected risks and returns have been answered. But to sum it up, I would say, the fund being a category 2 fund, first of all, attracts a marginal rate of tax. If it is able to generate a gross return of around 16%, the net of expenses, the returns could be, say, 13 to 14%. And then on that, one applies one's marginal rate of tax, and hence return becomes around, you can say, 9%, if I have to quote it, or it could be 8.5 to 9%. So that is the kind of an expected net of expenses, net of taxes returns. And arbitrage, if compared to any other debt mutual fund, would be around, say, 300 to 400 basis points. But having said that, obviously, one should do one's own due diligence. There is no advice, that should be construed from this entire discussion. It is more for education perspective. It is a product which, is to be seen by those class of HNI clients who can take risk of investing into an alternate investment fund. But obviously, it deserves an attention because this is a space which adds a lot of value in the overall portfolio construct and the overall asset allocation. And that is where kind of we, are very happy to have discussed this entire product in detail. We would come back to you with more pointers about this entire concept and product, set of our mailers. And in case you have any further unanswered questions, you please book a call with us. We are India's #1 and trusted alternates platform. We'll be happy to serve you. Thank you, everyone.